Good afternoon all, and welcome to SCORE Fairfield County. Steve, are you with us there? Hello? John, are you with us there? Folks, we're having a technical thing. We'll be with you in just a moment. Hello, John, Steve. Folks, we seem to be having a technical issue. Please bear with us for just a few moments. Hopefully you can hear us. Who is on with me in my speaker room? Hello?
Yes, hi.
Hi, who's this?
Oh, this is Kate Brooks. I thought I was only on the listen-in mode, but I'm here on the phone.
Okay. We seem to have lost our two speakers.
Oh,
and
oh,
I'm
no.
not quite sure of where they have gone to. We were chatting away very nicely, and then all of a sudden, when we went live, we seem to have lost our two speakers.
Something went haywire.
It's been known to happen.
Hmm. And I'm sorry if my munching is too loud. I'm having my lunch. I'm on lunch break.
That's fine. If I don't get speakers, I'm not even going to venture into this, folks. I am not a financial statement person. I'm the guy who's supposed to be making sure that you have a screen to see, and the telephones are not sure where they went. Sorry, folks. Wish I could give you a better answer than that. Folks, sorry for the technical difficulty. I'm trying to track down two people who aren't sitting in the same room as I am. Hi, where'd you go? I need you on this 310 number. We don't hear you. We don't hear you. I don't hear a thing. I don't hear a thing and nothing is moving. No, you're on the speaker with me. I don't hear a thing and nothing is moving. So he can't be on presenting. Well, I'm not seeing a thing. Oh, okay, then I'm not hearing a thing. This is, okay, I don't know. But if he's going, I don't hear him. But okay, great. Caroline says there is no audio. Slides are moving. So something is not working properly. I don't know what happened. Okay, I don't know. We'll regroup with Ready Talk. Okay, I'll talk to you later. Bye.
Hello? 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 Hello?
I hope hope you all have heard me.
Yeah. Go ahead, John.
Yep. Okay, good.
Yeah.
Then there's something called inconsistent categorization of revenues and costs. So I've seen some examples where an expense, that is an expense not related to directly delivering products and services to customers, is actually categorized as a cost of goods sold. You want to make sure that you are cleanly categorizing these revenues and consistently so. There may be insufficient revenue and profitability detail. We've already mentioned that. There may be insufficient tracking of key balance sheet items. And then finally, insufficient management of cash flow. Some businesses don't really look at their cash flow statements very frequently. That you ought to be looking at that at least monthly, if not more frequently. And then finally, financial ratios. We're going to get into this much more in detail, but there are three basic categories. And by the way, there are other kinds of financial ratios that we will not be covering today in general because they tend to be pretty arcane or they tend not to be all that relevant to small businesses. But the three ones that are most important in my mind are profitability, liquidity, which is to say how liquid am I, how well or how badly am I facing financial risk, and then finally efficiency. How quickly am I able to turn a short-term asset like turnover, like accounts receivable, into cash, or how slowly am I able to turn a payable into expense for the supplier. So these are the financial ratios we'll be getting into in more detail. Profitability ratios. We've already talked about gross profit. One point I didn't make earlier was that the gross profit can be used to calculate what is known as a break-even point. So if my gross margins are 50%, that means that 50 cents of every dollar of sales goes into covering my expenses, that is, those non-cost of goods sold expenses. And I'm able to calculate at what point my sales are going to be covering all of my costs, all my expenses, and at that point I become profitable. And knowing what gross profit means allows you to be much more aware of just how quickly you can become profitable. Operating profit, we already talked about that. That's operating profit before interest and taxes, net profit. And then finally, two things we didn't cover, which is return on assets and fixed asset turnover. Return on assets is what's the profitability compared to my total assets. We'll get into examples of this, but I want to know that my assets are generating the kind of profitability I want or not, in which case I've got to either make a decision that I've got to reduce my costs, increase my revenue, or rid myself of some unproductive assets. And then there's fixed asset turnover, which is to say how well do my fixed assets turn into actual revenue? How many dollars of revenue do I get out of every dollar of a fixed asset? And that gives you an idea of how productive my assets are in terms of revenue generation. Okay, so here's an example, and this is I've changed the names to protect the innocent, but this is a real-life example of a business. It's a catering business, and let me walk you through the income statement. First of all, there are revenue categories. In this case, the revenue is associated with different kinds of catered events. There are themed events, plated events where people actually sit down and are served by servers, buffets, hors d'oeuvres, weddings, etc. Each one of them has their own revenue contribution, and I can see what percentage of my revenue each of these categories is providing the business. Then I'm also tracking cost of goods sold by these categories, and you'll notice that some of these events have higher cost of goods sold than others. So my plated events have a 60% cost of goods sold, and my weddings have a 55%. That means that in terms of gross profit, my plated events are contributing less gross profit than my weddings. Now, I may decide that I want that to continue because plated events may lead to weddings. I may decide that I don't want to do plated events anymore, but at least I have some basic information about what each of these events is providing me in the way of gross profit. Then I look through my expenses. The gross profit for this business is about 42%. That's pretty much standard in the catering business. Gross profits run anywhere from 40 to 45%. You'll notice that expenses add up to almost 40%. This is a huge expense amount, and it's the main reason why the operating profit for this business is so low at under 3%. Once I add interest in expense and depreciation, my net income drops to below 1%. So this is a business in terms of profitability which needs to improve, and we'll show you more about how they'll do that. But initially, if you look at the expenses, sales, general, administrative expenses, they're very high. And the question is, do you cut these costs, or do you increase revenues to be more appropriate given the administrative expenses? Here's another look at the two other profitability ratios we mentioned. One is return on total assets under 1%. The other is fixed asset turnover. It's interesting to note that for every dollar of fixed assets, they're generating over $4 of revenue. That's pretty good. That's very good. The problem is that their expenses, the total costs, are so high that it's eating away at return on total assets. And the question is, well, what do you do about that? And again, the question is, do I increase my revenues? Do I decrease my administrative expenses? And, of course, that's a strategic business question that every owner has to wrestle with. The second category is liquidity, and this measures risk. This is an area that small businesses don't tend to focus on very much, but if you're looking at the risk factors carefully enough, you'll know that you are either in danger and need to do something about it, or you're okay. If you're never looking at this, you'll suddenly find yourself at the high risk of becoming bankrupt because you haven't really looked at those risk factors. And what are they? Well, there's something called a current and a quick ratio. The difference between the two is the current ratios are really more important for businesses with inventory, and quick ratios are really more important for businesses without inventory. And basically, it's a comparison of the cash and accounts receivable, your short-term assets, to liabilities. And for those without inventory, you want to make sure that your quick ratio is at least 1-to-1. I have about the same value of short-term assets that I do short-term current liabilities. You want to try to do that more. You want to try to get a higher ratio if you can. But if you drop below that, what that says is that you run the risk of either becoming financially under stress if you lose a big customer, or if suddenly you have a supplier that's demanding immediate payment, and you want to understand what that looks like. And then finally, there's something called days of cash, where you try to calculate, given the cash I have every day, how many days of cash do I have to cover whatever expenses I need? We'll give you some examples of that, but basically your days of cash should cover anywhere from 30 to 60 days of your cost requirements, basically to cover a payroll or two coming up. And then finally, it allows you to understand the sleep at night factor. In other words, do I feel comfortable that I have enough cash to cover any future obligations? And here's another example of liquidity ratios. So in the case of the current ratio, I'm taking my total current assets, in this case inventory is included. I'm comparing it to my current liabilities of $31,000, and I have a current ratio of 4.6-to-1. Excellent. Very good. And the quick ratio looks roughly the same. If I just take cash and my current liabilities, cash and accounts receivable, and I compare that to current liabilities, 3.7-to-1. really, really good. The problem is that the days of cash, as calculated, come up to 6.3 days. That's not a lot of time. And if for any reason there is a need to cover some future obligation, you only can do that for a little over 6 days. That's a pretty risky area. And in this case, this customer is in a very financially risky situation. And I might point out one of the big factors in this risk is their accounts receivable. They have over $100,000 worth of accounts receivable. We'll get into how we actually calculate why this is a bad thing in a second, but that's one of the main reasons why the days of cash in this case are so bad. There's efficiency ratios, which is to say how quickly am I able to generate cash out of my inventory, out of my accounts receivable? How fast do I pay off my accounts payable? And how much cash am I wringing out of my operation, which is your days sales outstanding plus your days inventory outstanding minus your days payable outstanding. We'll get into these examples, but it's another way of showing just how efficient your business is in taking a short-term asset and turning it into cash. This is an example of that. So in this case, I have a accounts receivable of $100,000. When I do the math, when I do the calculation, it turns out I have almost 42 days of accounts receivable. That's 42 days of cash that your customers have and you don't. And generally, you're looking at a day sales outstanding that should be under 30 days. Some of that has to do with your terms and conditions. Some of that has to do with how well you keep after customers who need to pay you. And some of it may have to do with your decision not to go after a large customer who owes you money because they're a large customer and you can't afford to lose them. Days inventory outstanding, same kind of calculation. In this case, they got 25 days worth of inventory. In the catering business, you shouldn't have 25 days of inventory because a lot of that inventory is perishable and probably doesn't have a life of much more than 1 or 2 weeks, or you're freezing it, in which case you run the risk of offering a low-quality product to your customer. And then days payable outstanding. Unlike day sales outstanding, this customer is paying off their suppliers very quickly, less than 2 weeks. And you can see between days sales outstanding and days inventory outstanding, less the days payable, that's 53 days of cash that's sitting on the table, not available to this customer. And this is the cash flow statement. This is what we referred to earlier, which is to say I have this is an annual, and you probably want to do this monthly as we've shown, but just to keep it simple, I have an annual cash flow statement where we had $15,000 at the start of the period. The sales were 873, accounts receivable 100, inventories were 35, and you can see bottom line is that they are losing for that period of time, for that year, $136,000 worth of cash, which has to come from somewhere. It has to come from an IRA. It has to come from Uncle Fred. It has to come from somewhere. So understanding what the cash position looks like and understanding what the source of that problem is are part of the analysis you need to make. In this case, two things are driving the cash position. One is accounts receivable and inventory. Two is a very expensive set of expenses they've got. Almost 40% of their total cost structure is expenses, and generally those expenses need to be in the 30% range or so, or you'll never make any money. So that's the review of the example. I might just make make some final points here on the practical uses of financial ratios. We've already mentioned, use your cash flow statement as a leading indicator of financial strength or weaknesses. It is the canary in the coal mine. If your cash flow statement is positive, if your cash flow statement is consistently positive, it means that you're running your business pretty well. If it's not, it means that you've got to try to figure out the problem, and the cash flow statement by itself doesn't do that. It just tells you got to look further. We've mentioned a few key ratios in this presentation. Don't try to manage your business with 85 different key ratios. Pick a couple that are really important to you. It might be gross margins. It might be day sales outstanding. It could be return on assets. But pick a few that really signal to you how your business is running. For most small businesses, the key ratios are likely to be gross margins. We've already talked about that. Net income, day sales, and days inventory outstanding, and then positive liquidity, which is to say current or quick ratios that are greater than 1.5. By the way, in case you've heard it, these are also statements about working capital. It's another way of describing the difference between the value of your short-term assets and the value of your short-term liabilities. When selling your business, your other ratios are going to come into play. Return on assets is certainly going to do that. They're going to want to know, if I buy this business, is the return going to be good enough for me? Is it going to be passbook savings, or is it going to be over 10 or 12%, a return that I couldn't possibly get through any other investment? How good are the assets in generating revenue? And those things are really more important when you sell your business or when you're trying to merge your business with someone else's. Generally, it's not something you need to look at on an ongoing basis. As a matter of fact, as a business owner, you might be sacrificing return on equity in the short term in order to grow the business long term. That's a strategic decision that you can make, but at least you'll be conscious of the financial implications of that decision. And finally, there's more to running a successful business than financials. There's always a trade-off between strategy and between business policy and making money. It could be, if I'm a new business, I may have to have a supplier that's local and that is reliable, and I'm willing to pay more for that locality and that reliability in the short term so that I can get my business up and running. That's a strategic decision. I may decide that I have a customer that's way too valuable for me to chase after and get them to pay within 30 days. I used to work for PItney Bowes, and PItney Bowes had a policy of not paying within any time sooner than 45 to 60 days. Why? Well, because they could get away with it, because their suppliers knew that the PItney Bowes was going to pay. They also knew that PItney Bowes was a very, very successful and reliable company. So these kinds of decisions you have to make all along the way. Don't run your business solely on financials. Use judgment, use strategy, and I think the key is just knowing what the financials look like so you can make valid, good, solid business decisions. So that is the presentation. Happy to entertain any questions.
Okay, John, thanks very much. First off, let me fall on our sword here and apologize for that audio problem we had at the beginning. Best I can tell, there was a group of people who were online with us that could not hear approximately the first 12 to 15 minutes of John's talk. And, we apologize for that profusely. But let me add that it was recorded. The entire presentation was recorded, and the recording will be available at scorefairfieldcounty.org. usually takes us 3 or 4 days to get it moved over and operational. So by the end of the week or Monday, it should be there. And again, the entire presentation, both slides and audio, will be there. And again, I apologize for this confusion as we got started. So again, put your questions down in the chat room. I have one from Scott Fuller, and John, I'm going to need your help on this one a little bit. Here it's, does SCORE provide a similar presentation for not-for-profit? And I do know, Scott, that we do at SCORE have workshops on running a nonprofit organization. I went through our schedule after I saw your question, and I don't see one teed up at the current time. But it just asked John either to comment on financials for a nonprofit off the top of his head. How do you like that for being put on the spot? or to give us some kind of guidance as to when we might. Well, I guess it's up to the two of us to decide when we might put nonprofit back on the workshop agenda. So, John, there.
Okay.
Give it a go.
Yeah, happy to comment. First of all, nonprofits are a business, and nonprofits have financial requirements in order to stay solvent. So in some ways, the income statement for a nonprofit is going to be roughly similar to what it looks like for a profit business. There are going to be different categories of revenue sources. Some donations, for instance, are for specific purposes, and so you've got to relate the donation as revenue to a specific purpose and have to account for it specifically. That gets into rather complicated detail, but still, it's all about running business. It's all about covering costs, and in that sense, at a high level anyway, the income statement is going to be roughly similar in structure for a nonprofit than it is for a profit-making business. That said, it deserves its own workshop without question. And it's something that we have talked about doing, and with your question, we may accelerate our work on this. Okay?
Yeah, thanks, John. That's good. And I have another question here from Michael Parati. I hope I said your surname correctly. John, this is directly to you. Why do you feel gross profit margin is more important than net profit?
Well, first of all, if your gross profits are not within a certain industry range, then you have very little hope of getting any kind of net profit. So it's the first step of profitability. It's what you're doing for your customers. You've got to make sure that it's profitable enough. And the point I made, depending upon the industry, that gross profit margin might be 50%. It might be 30%. It might be 60%. But there is some standard around gross profit which will indicate that you're running your business on a gross profit standpoint profitably. The second point is that gross profits allow you to understand your break-even point, which is to say, if I have a gross profit of 50%, that means 50 cents of every dollar's worth of sales is going to be covering my expenses. And that will allow me to know how many sales dollars I need in order to cover all of my expenses. And at that point, I become profitable. And knowing what that point is allows me to know things like, well, maybe should I increase my price? Or do I need more sales? Or should my gross profits be better? And they're not. So that kind of analysis can help you tinker with. It's not quite the word, but it allows you to understand what the variables that go into gross profitability are and what you need to do to manage them better.
Okay. Good answer. At least I understood it. Yeah, Michael really says thanks. Okay, great. That's what counts. Okay, now I have another Michael here, Michael Johnson. Is it possible to show a demo on how to run a P&L and a balance sheet other than from QuickBooks?
I'm not sure I understand the question.
Yeah, well, I'm not sure. A demo. Michael, you say show a demo of how to run a P&L other than from QuickBooks. You want to elaborate on that just a little bit, if you don't mind typing a little bit more in? But let's return to that one, and I want to jump to Lawrence Glenn. Yeah, go ahead.
Yeah, quickly, you can use an Excel spreadsheet if you want to for P&L and balance sheets. It's just more cumbersome. It doesn't have all the built-in formulas that allow you to enter information quickly and have the calculations done for you. But please, would be interested to hear more about why you're asking that question. Go ahead.
Yeah, from Lawrence Glenn. How are these records, I assume it means these financial records, best kept? In a restaurant, for example, does the accountant receive the data daily, hourly, weekly? What?
Yeah, that's a really good question. I'm going to just use an example of QuickBooks because that tends to be the financial tool that most small businesses use. There are two ways to keep those books. One, the owner keeps them every day. So every time there's a sale, they register that sale. Every time there's an expense, they register the expense. Every time there's an asset that's added, they register that. But it needs to be done on a daily or at least a weekly basis, allowing that financial information to sit in a folder somewhere is a recipe for running your business incorrectly. Many other small businesses use bookkeepers. That's fine. Bookkeepers do provide a good service. Accountants should not be entering data into your income statement, your financial statements, because they're very expensive. Accountants charge, on the average, a couple $100 an hour. Bookkeepers charge, on the average, $40 or $50 an hour. And bookkeepers, by the way, in just entering that data, can do everything that an accountant can. Just make sure that your bookkeeper is accurate. I have some clients whose bookkeepers were careless, either because they were sloppy or because they didn't know any better. They were careless about what information to add in what category. In every case, whether the owner is maintaining the books on a frequent basis or a bookkeeper is maintaining the books, it's important that the owner understand what's going into those financial statements. Not knowing that will generally get you in trouble over time as those financial statements no longer reflect accuracy.
Okay, got it. Hey, back to Michael Johnson, John. He's added how to download reports from QuickBooks that I use daily. Does that shed any additional light on it for you?
Well, yeah. So QuickBooks does have the capability of feeding an Excel spreadsheet. And by the way, we have a workshop coming up on QuickBooks. I think it's coming up later this month. And I'll
go check. Yeah.
Yeah. We do have somebody who's going to be presenting on QuickBooks. And exactly how that occurs, I'm sure she'll be able to cover. But QuickBooks allows you to take that QuickBook information and populate an Excel spreadsheet, if that's what you were looking for.
Yeah, I was just looking here. Okay, John, great. I was just looking here quickly to see if I could find the date of that. Oh, wait a minute here. Yeah, on August 9th, which last time I checked is today, the Darien Library from 6 to 8 p.m., there is a workshop called Introduction to QuickBooks. It's by Sarah Pfluger. And so if you've got a chance to see that might be definitely be worthwhile to you. So that's good. Let's see. Yeah, and John, okay. Yeah, okay. So that's it. Michael's happy with our answer. Okay, so let's see. I think we're out of current questions. So I'll just give a second here for folks to put together your final thoughts and ask a final question or two to John. We've got a couple, eight minutes or so. Also, let me again. Yeah, go ahead, John.
Just a comment on this. I am very interesting to note how seldom business owners use financial statements in a complete way to help them understand how their business operates. Some of it may have to do with just the confusion about what financial statements are all about, terminology, etc. I can tell you that for most small businesses, it's not hard to learn. And once you are doing this, you'll find that it becomes a really important part of how you run the business. Part of what SCORE offers is not just workshops like this, but the ability one-on-one to go over P&Ls and make comments on how they're structured, on asking questions about why did you label it this and why did you include it that there, and how about this, have you thought about that? All these questions can help you better understand how you're maintaining your current financial statements, how you can improve, and once you get there, you'll find a comfort level, almost a requirement that you can't run your business without looking first at your financial statements on a frequent basis.
Okay, good addition, John. Thank you very much for that. Hey, I've got a quick question here from Lawrence Glenn. Other than QuickBooks, are there any other systems of that kind for record keeping?
There is one, the name of which I can't recall, but there are some accounting systems for small business. My experience is that QuickBooks seems to be the most ubiquitous tool for small businesses in generating financial statements. There is one additional thought here on QuickBooks. There is a version that operates on your C drive that you load the software into your computer. There's also a version that's in the cloud. And as I understand it, the cloud version is a little less flexible, maybe a little less useful than the C drive version. And I'm not sure if that's why the question came up, but if you are using QuickBooks in the cloud, consider the version where you actually load the software into your C drive and operate it from your own computer.
Hey, John, are you familiar
probably Go ahead.
Are you familiar with Peachtree?
Yes. Yes. Peachtree, and I must say this is what I've heard, and I've not used Peachtree myself. Peachtree is probably more useful for larger businesses. It's a little bit more complicated, a little bit more difficult to maintain. QuickBooks seems to have become much more of a useful tool for smaller businesses because of its simplicity.
Mm-hmm. Okay, great. Hey, now here's a really great idea. I should have thought of it myself. From Michael Partee. He said, since we didn't have sound at the beginning, and we've got a few minutes here, could the speaker, that would be you, John, go back to the first couple of slides, like let's just say for the sake of trying to be clear here, slides 4 and 5, if you can go back to them and try to kind of like represent them in a very short period of time, like 4 or 5 minutes.
Okay. Let's see. I'm going to start with the growth plan tools. Why don't I start with counting basics? That's probably more important. Growth. There are two accounting methods. One is the cash accounting method, and one is the accrual accounting method. The cash accounting method is just as the phrase describes. You register the income when you get the cash. If I offer a service, let's say I'm a plumber, I offer a service, and I send out an invoice for that service. I fixed a leak under the kitchen sink. I don't register that income until I get the cash from the invoice I sent out. And that cash might not come in for 60 days after the service was provided. Cash accounting is fine for tax purposes. The IRS allows you to use cash accounting. But unfortunately, cash accounting doesn't reveal the operational characteristics of your business. Accrual accounting will. Accrual accounting accounts for revenues and costs when you actually get the sale or send out the invoice or incur the cost. That is, you receive a supply of office material, or you receive a desk. Knowing when that occurs is really important. A good example would be a marketing campaign. If I have an email marketing campaign and I start it in June, and I don't pay off the costs until August, I don't know from a financial point of view when I really started that marketing campaign, nor do I know when the results of that campaign start coming in if I'm doing cash accounting. So I may have a marketing campaign starting in June. I may start getting results in December, but I really have no idea what activity has been going on between those two events, as I do with accrual accounting. So that's an important consideration. The second bullet has to do when I recognize revenue and expenses. If I'm a restaurant, it's pretty easy. Somebody comes in, they have a meal, they pay for it. I recognize that revenue immediately. There's no mystery there. On the other hand, if I am in the services business, say I'm a consultant, and I have a 5-month assignment, and there's some deliverable at the end of that assignment, let's say a market research report of some kind that's taken me 5 months to do, when do I recognize the revenue for that if I'm working all those 5 months? Do I recognize it all at once at the end, or do I recognize it in stages? And what I usually suggest to clients is you have some steps within coming up with that deliverable that you recognize as revenue recognition steps. So I may have, in my market research report, I may have some initial data collection. Well, I'll recognize the revenue for that initial data collection. I may also have some analysis and comparison. I may recognize the revenue for that analysis and comparison. And finally, I may have the final report. I may recognize some portion of that revenue at the end. There are industry standards about when you recognize revenue. It can get very complicated. I don't want to get into it here, but it's important that you understand how you are intending to recognize that revenue when you receive it if you're doing accrual accounting. Chart of accounts is really a series of labels of revenues and costs. You want to make sure that you have enough discrete categories of revenue and cost to make it meaningful and to make your financial statements revealing. What's an expense and what's an asset? An expense is anything that you purchase that has a life of less than 12 months. Office supplies are a good example. An asset is anything you might purchase which has a life of more than 12 months. Computers or computer software is a good example there. And then finally, depreciation and amortization. That's the amount of use you get out of an asset. The example I gave earlier was a $20,000 car. If the car lasts 10 years, that means I've used 10% of that car in the first year. I recognize that as an expense, and it's $2,000. But by the same token, I need to take off the value of that $2,000 from that $20,000 asset. It now becomes after a year an $18,000 asset.
Mm-hmm. Right.
That is, I can go on. I'm not quite sure.
Yeah, well, I think that's good. Rather than getting into the statements again in that detail, and we're pretty much out of time anyway. But John, just one quick one. It should a 5-second answer here. I just got a quick question from Yvette on the typical rates for external bookkeepers. I think you said a minute ago $40, $50 an hour. Is that about typical?
Yeah, that's about right. You'll find bookkeepers that may charge more than that. They may offer more services than that. I'm not necessarily describing some value associated with that number, but that's typically what you spend on bookkeepers.
All right, good. Great. Thanks very much, John. That was good, and a lot of ad-libbing here. And I think we had some very, very good questions. And again, thanks to everyone for bearing with us here through that lack of audio stage at the beginning. And one more time, you can get the presentation audio and visual online at our website, scorefairfieldcounty.org, in 3 or 4 days. It'll be there. That's Janice. That's the answer to your question. And so I'm going to end the webinar now, just with a reminder that on September 6th we have our next webinar, Using Free Software with Ludwig Fund. And John, I want to thank you for presenting today. And to all, remember to visit the website. Have a nice day, and thank you very much for joining us. Goodbye.